Hello and welcome to CMXtra, the Capital Markets Exchange podcast. I'm David, and in today's show, we're looking at Trump and trading. Just what does Donald Trump's presidency of the United States mean for global markets? Oh yes, we are definitely going there. But before we do, a reminder that here on CMXtra, we cover topics as diverse as surviving market blackouts to AI on the trading desk and everything in between, as well as hearing stories from the industry's rising stars and next generation of trading leaders. And if all of that sounds like it floats your boat, then do look up our back catalogue, our extensive back catalogue now, and hit subscribe wherever you get your podcasts. And while podcasts certainly are a great way to keep up with what's happening in the industry, nothing beats a bit of in-person networking. So later on in today's show, we'll be sharing details of in-person events coming up in the CMX universe in 2025. But back to today's topic. Love him or loathe him, there's no denying that Donald Trump shook up the global economy like few leaders before him when he took office in January 2025. From tariffs to tax cuts to trade wars and deregulation, his presidency has sent shockwaves throughout markets worldwide. So, after a turbulent 2 or 3 months at the helm, what have we learned so far about Donald Trump's second term? And if the only thing that's predictable is unpredictability, what does this all mean for traders, investors, and the broader global economy? In amongst the volatility, are there new opportunities or just heightened risk? Well, here to help me cut through some of that noise is Head of Macro Strategy for North America at State Street, Lee Ferridge. Hello, Lee. How's it going?
Very good, thank you. Thank you for having me.
No, thank you very much for being here. And, well, where is here for you?
I am based in Boston, as you can probably tell, originally from the UK, but I have been in Boston, Massachusetts for 15 years now.
Fantastic. And I think the job title gives a fair bit away there, but just give us the kind of macro level view of what it is that you do there at State Street.
Yeah, so essentially my team, we work in the global markets division of State Street, and we produce research, develop views on FX markets, equity markets, fixed income, interest rates, the whole gamut, say multi-asset, to work with our own trading team and also with our clients, our extensive client network. So our job is to try and make sense of the world and tell them where markets are going.
Wow, making sense of the world, particularly at the moment, is quite a tall order. But let's see what we can do over the next half an hour or so. As the saying goes, Lee, when America sneezes, the world catches a cold. But there seem to be quite a few high temperatures and hoarse voices closer to home right now as well. What typically do we see around presidential election cycles in the US, and how does this compare with other major global events?
It very much depends. I mean, for a number of years, politics didn't really matter for markets. Through the 90s and you would argue the 2000s, political leadership, when it changed, was largely slightly left of centre to slightly right of centre or vice versa. And you didn't see radical policy changes. That did start to change in the mid-2000s. We had Brexit in the UK, and then geopolitics mattered again. And then closely followed by Donald Trump's first election victory, which sort of shook up the world order to a degree. And now, obviously, we have Trump 2.0, which is shaking things up even more than the first time so far in the first sort of 6 weeks or so. But I mean, I think it's fair to say for a lot of my career, politics per se has not really mattered that much. It does now because we have people who have different policies, different agendas, and we're seeing a much bigger shift in political sort of ideology, if you like, than we ever did through the sort of 90s and 2000s.
And certainly pushing the boundaries, pushing the buttons, just testing how far in certain directions one might be able to go from economic points of view, also legislative points of view as well. These are uncharted waters in many ways there. And, it's uncertainty that can drive volatility. With regards to this new presidency, what specific uncertainties are you seeing as most impactful at the moment? There were lots of promises that were made in the build-up, and obviously in the US, it's an extremely long build-up to a presidential election and inauguration. But what have been the uncertainties that you've seen that have led to this period of volatility right now?
I mean, there's no doubt that since the inauguration day, the major focus for markets, particularly FX, but also in equities and bonds as well, has been the threats, the imposition, the relaxation of trade tariffs. Trade tariffs are something we saw in Trump 1.0, but very targeted towards China and limited to the number of goods that it impacted. This is a much broader sort of policy of trade tariffs. And we've had announcements. We had an announcement not long after Inauguration Day of 25% tariff on Canada and Mexico. That came out over a weekend, and then on Monday it was delayed by 30 days. We've had numerous sort of on-off delays. And that's the volatility we're talking about. Trade tariffs is a policy we haven't worried about for decades and decades. Suddenly it's front and center, but not only that, it's sort of, well, where actually are we? Are they going on? Are they not going on? When are they going on? How high are they going to be? And there's still a view for a lot of people in the market that we're not really going to get trade tariffs in the end, that this is a negotiating tactic, and we're not really going to get them imposed to any large degree. I think that's the wrong assumption, but that is still the underlying assumption that a lot of people have.
I mean, the reasoning given for some of that first wave of tariffs, particularly with regards Mexico and as regards the 51st state, potentially Canada, was the flow of drugs into the country. And that was the reason given, despite assurances to the contrary, though. But it has been part of, like you say, Donald Trump's rhetoric for a long time. And now we're seeing that in action there. But your view is that this isn't just an initial period of volatility here. Your view is that maybe we should expect some longer term things may settle down, but we will see higher tariffs as a result of whatever happens over the first 2, 3, 4 months, perhaps.
Oh, most definitely. I think what people misunderstand, they're starting to get there, but what people have misunderstood for basically since the inauguration, even since the election, you could argue, is that Donald Trump sees trade tariffs as a couple of things. The more immediate sort of reason for them is revenue. So, a big part of the sort of Trump agenda is to extend the tax cuts that were put in place in 2017. They are due to expire at the end of this year. When they were put in place in 2017, they were only for a certain period because that's how you could get them passed through Congress and not be seen to increase the deficit over the 10-year period. So they were due to expire at the end of this year. They still are. Donald Trump obviously wants to very much avoid that, and he wants to codify them into law so they become permanent. Well, over the next 10 years, doing that would cost around $4 trillion, adding on to the deficit. There are other tax policies he wants to change, and various ones have been mentioned: lower corporation tax, no taxes on tips, various other, maybe elimination of state and local tax offset against federal tax, so-called SALT taxes. He wants to take that limit off. Those added together will probably cost another $1.82 trillion. So in order to get that policy through Congress, and there are still fiscal hawks within the Republican Party that he needs to get on side, he needs to show, well, actually legislatively, he needs to show that he will still not increase the deficit over 10 years. Yeah. How do you do that? By getting a new source of revenue. And the new source of revenue is trade tariffs. If he can raise $500 billion from tariffs a year, over 10 years, that's $5 trillion. That largely pays for what he wants to do so far, with some dynamic scoring from the CBO who scored the budget. You can get to sort of neutral over a 10-year period by using trade tariffs. So that is the immediate sort of argument here. Yeah. The longer term argument is, and I think Donald Trump really believes this from a sort of, an ideological, philosophical point of view, is the US has been taken advantage of by others in trade for many years. The US runs the biggest trade deficit in the world, over $1 trillion a year. His view is others don't play fair. And also, it's detrimental to the US because so much production is overseas and then imported back to the US. So, by imposing trade tariffs, the longer term aim is to bring in production, bring companies back to the US, and basically ring fence the economy in that way. So, there's a longer term sort of philosophical argument here, and there's a nearer term revenue argument in order to pay for the tax cuts, which is part of the bigger vision and fiscal sort of idea as well.
So that's a very clear position. Now, we're recording this mid-March 2025, and certainly over the last few days, we've seen some more tariffs, the whiskey tariff with the European Union, for example. Again, we'll see how those play out and whether there is some brinksmanship there or there are some further negotiations. But what is the impact so far on the markets? How have they been watching this, responding to this? And do you see that as having a kind of short-term pattern in amongst the volatility, but also a long-term pattern as things do start to take shape with Donald Trump's picture?
Well, I think just to pick up on your point about the whiskey tax and everything else, again, there are two levels here as well with the tariff. There's a baseline of tariffs that are going to go on. We'll get the full picture of that in early April when we get the reciprocal tariffs, which is going to be the main sort of thrust of this. And that comes from an act in the 1930s, the Reciprocal Tariff Act. So that's how he can put those tariffs on. And then you have the sort of the ad hoc ones that come up. That we had one earlier this week on Canada when the tariff on steel and aluminium imports from Canada went from 25 to 50% because Canada had imposed a 25% tariff on electricity exports to part of the US. Canada backed out on that, and so Trump took that tariff back off. So there are elements which are negotiable. The 200% tax on alcohol and wine and beer coming from Europe that went on earlier this week as well. That might be negotiated away, but don't confuse that with the underlying baseline of tariffs that are coming. Now, to go back to your question about what does it mean for the market, it's meant volatility. I mean, you look at the equity market. Over the last month, the S&P is down by over 8%. The Nasdaq is down by nearly 12%. Because not only the tariffs, and the tariffs have sort of impacted FX and rates as well, but a development over the last few weeks has been an increased fear about recession in the US caused by the tariffs and the uncertainty. So this started in sort of a few weeks ago when we started to get consumer confidence numbers for January. They took a big hit. We saw a number that was released today, actually, from Michigan that showed another fall in consumer confidence. We had a weak retail sales number, and people have sort of leapt on that, and the uncertainty around policy, tariffs and fiscal and everything else, to say, look, this is holding back consumers, it's holding back companies from investing because they don't know what the landscape looks like, and this risks pushing the US into recession. So the tariff talk combined with that fear about recession is what's behind the sort of decline we've seen, the volatility we've seen in markets overall, and the sharp decline in equity markets.
Yeah, and the consumer confidence piece in there, I think, is really important as well, because a lot of the rhetoric is brilliant. Money coming in through trade tariffs, fantastic, but the kind of complex supply chain interplay, whether it's steel, whether it's automobile manufacturing and so on, stuff crosses borders many, many times there. And the fear is it's going to hit the voting public in its pockets way before there is actual benefit seen in terms of their taxes. Is that does that degree of concern have an immediate impact on the markets as well at the moment?
Yeah, I mean, it has. And as I say, that's why the equity market is down. I mean, what we have, as you rightly pointed out, is something of a sequencing issue here. So there are certain Trump policies that he wants to put in place that are positive for growth. The tax cuts. So more fiscal stimulus is a positive for growth. Deregulation, which is a big cornerstone of his agenda. That takes time. So that's positive for growth, though. And also his energy policy, drill, baby, drill, and getting lower energy prices, which would be, a cut in costs for consumers. Those three things are all growth positive. They're not what we're talking about right now. What we're talking about, first off, are trade tariffs. Also, what's happening with Doge and Elon Musk and
Oh,
the
yeah.
paring back of government and laying off of government workers, and also the immigration policy, with the southern border and etc. So those three things are more negative for growth, and they're happening now. The things that are going to be positive for growth are coming down the line. But the question is, can the economy, how much of a hit does the economy take from that first wave of tariffs? The Doge sort of news headlines, and also the immigration policy. What's the hit to growth from that? Does that push us into recession before we get the benefit of the
Yeah.
pro-growth policies from fiscal deregulation and energy? And that's what the market's grappling with. And that's sort of certainly the narrative over the last 2-3 weeks has been, look, we're going to get hit by this, and this is hitting the consumer, and that risks recession.
It is that kind of shock and awe thing, though, isn't it, as well? And we see this in political cycles the world over, not just in the US, that the unpopular stuff takes place towards the beginning of a term. And then it's hopefully for the party in charge that the benefits of that will start to become apparent towards the end of the 4-year, 5-year cycle in order to encourage continuation there. Of course, another lever that we see in markets all over the world to try and stimulate growth or just to control the economy are interest rates. Where are things in the US with the federal rate right now?
So what we've had because of the fears about recession is we've seen actually an increase in Fed rate cut expectations for this year.
Mm-hmm.
So in January, there was only one Fed rate cut priced in for this year. We had four at the end of last year. 100 basis points, sorry, three cuts, one of 50, two of 25 from September. But by January, we'd only had one price for this year. The view being at the time, look, the economy is doing fine. The labor market is doing fine. Inflation is sticky. Wages are sticky. Not coming down as much as the Fed wants. So that's why the market backed away from the rate cuts. And then the view at the time was, well, look, trade tariffs are inflationary, right? That's, the first impact is we're going to see higher prices from trade tariffs. So the focus was there. And then it suddenly switched to this growth argument because consumer confidence took a knock. The headlines about Doge, and government workers being let go, that led to this fear of recession. So now we've priced in 3 Fed rate cuts because of the threat of the slowdown. Look, I am still in the camp. I don't think the Fed will cut 3 times this year. I think there's a chance they don't cut at all this year, on the basis that I don't think the economy is going into recession. We've had, as I say, a lot of headlines about tariffs, and tariffs will come. The first impact from tariffs will be inflationary, and that's going to keep the Fed on the sidelines. I think there is enough momentum in the economy. I think there is enough momentum in the consumer for them to continue to grow and wait for the positives to come through. So, look, the growth might slow. I don't think we're going into recession. And that being the case, the Fed is going to look more at the inflationary impact here. Tariffs are a tricky one because are they inflationary? Not in the classical sense. They cause a one-off adjustment in relative prices. So if you put a tariff on this year, your calculation of inflation, your CPI will go up this year.
Yep. Yep.
But if the tariffs stay the same next year, that will drop out of the inflation equation. So it's not something. So real inflation is inflation that leads to more inflation. It's like a wage price spiral. So higher wages lead to higher prices lead to higher wages. That's a wage price spiral. That's persistent inflation. A one-off adjustment in a tariff or even tax rate, when VAT goes up in the UK, for an example, that's not seen as inflationary. It's just a one-off adjustment in VAT, and the next year it drops out. So for the Fed, it's a very difficult balancing act between looking at higher inflation this year and looking through it to say, well, hang on, that's going to come out next year, so we shouldn't overreact. So this is the problem they have. But optic-wise, it's very difficult to cut when inflation has gone up because of tariffs. And the thing they watch, and all central bankers will watch, is inflation expectations. because if inflation expectations start to rise, that's when they worry. Because if consumers expect higher inflation, they push for higher wage increases, and then you get to that more persistent higher price pressures. And so inflation expectations have been rising. We just saw again data this week from Michigan showing a big jump in inflation expectations. I'm not a big fan of that survey, so I'm not overreacting to it. But overall, we're seeing inflation expectations start to rise. So that's something the Fed are going to worry about. And this is where I come back to 3 rate cuts this year. Looks too much to me.
Let's cast our view slightly broader there. We've looked at how the US has got a bit of a sniffle at the moment, but other parts of the world that maybe maybe catching a cold or maybe watching the sneeze from afar and covering their faces. Europe, the ripple effects in Europe right now. Obviously, things are complicated by the geopolitical situation and the part that the USA plays between China and also with what's happening with Russia and Ukraine at the moment. But needless to say, they are all interconnected, and we've already seen some moves with regards to defense spending, with regards to Europe understanding that maybe it needs to stand on its own 2 feet a little bit more, not only from a defense point of view, but from a supply chain point of view. And supply chain security has been a big talking point, certainly for the last 5 years or so, since the pandemic became a thing. So some of the unintended consequences, perhaps, are the UK and other parts of Europe investing inwardly and not taking so much US investment, or not taking on so much US investment, starting to stand on their own 2 feet. Is that something that you are beginning to see as well? And do you see that will have legs potentially as we continue in the Trump term and beyond?
We've already seen it in Germany, most notably. The new German Chancellor Merz, a dramatic announcement last week, actually, about legislation to basically remove the debt brake. Germany's had a debt brake for decades to limit their fiscal spending. And last week it was announced that the new government want to change that. And even it looks like, as we speak, they needed the Green Party to come on board. So you've got the alliance there of the 2 major parties, but they needed the Green Party to get to a 2/3 majority in the German, in the Bundestag, to effectively change the constitution, because this debt brake is written into the constitution. It looks like they've got a deal. And this is a huge game changer in terms of fiscal policy in Germany. So it will release 500 billion euros for an infrastructure fund and also remove defense spending from the debt brake calculation above 1% of GDP. That's a huge game changer in terms of Germany's fiscal outlook and Germany's attitude towards taking on government debt. And look, you can thank Donald Trump for that. For years, people have argued that Germany was the economy was struggling. It's underperformed for a while, and fiscal policy was too restrictive. Well, that has changed, and there's a good chance that if Germany does this, others within the Eurozone will follow. The UK, there is talk about increased defence spending.
Yes.
UK's it's complicated because you do have the fiscal rules, and we know that Rachel Reeves, the new chancellor, or relatively new chancellor, has come up with problems with the fiscal rules, and we'll see later this month when we get the budget what she does in terms of that, because it's almost certain she's going to miss them based on where we were in October and the last time they were scored.
And the contraction announced only today as well here in the UK.
Exactly,
which is somewhat
in Q1.
unexpected.
So I think the UK's room, maybe they can, like Germany, find a way around it to ring-fence defence spending because they need to. As you said, it's got to a point now where Europe probably does have to increase their defence spending. They have we've had a bit of a free rider problem whereby the US is protected and spent a lot on defence, and others have sort of not spent the same amount. Now it seems that balance might be shifting. So that's a very positive, development in terms of growth in Europe. Look, we're coming from a low base. It's going to take time for this stuff to feed through. So it's not going to be a game changer this year, I don't think. But moving forward, yeah, you are going to see increased defense spending in Europe.
Yeah, and so that speaks to kind of fiscal rules and inward investment. Then, as far as investor sentiment, whether you are pension funds, whatever, how do you see that impacting capital flows across Europe, in and out of the US, maybe in and out of Asia as well?
Well, I mean, certainly in Europe, we've seen it already. If you
Mm.
look year to date, for an example, so the S&P 500 is down 4.5%, the Nasdaq is down 8.4%.
Yeah.
The Euro Stock 50 is up 10.4% so far this year. The DAX is up 15%. So against the 5% decline in the S&P, 20% outperformance by European stocks over US stocks so far this year. And we haven't seen that for years. US stocks have outperformed. US growth has been much, much stronger than the rest of the world post-pandemic. The phrase US exceptionalism has become fairly commonplace because of how strong US growth has been relative to others. The technology sort of bias of US stock indices, the Magnificent Seven has led the way. But this year, there's been a shift. And, in State Street, we're lucky we have, for 25 years, we've produced a range of investor behavior indicators. We can look at real money flows. We're the biggest custodial bank in the world. We custody $45 trillion. And we can, for 25 years, we've produced indicators showing what real money investors are doing, what they're buying, what they're selling across FX, equities, and fixed income. And we see a big shift into European equities, out of US equities. And we haven't seen it for many, many years. And you're seeing it now. And the euro, earlier this year, we were talking about parity in euro dollar. We're now up around 109 in euro dollar. We've bounced sort of 4%, 5% since the announcement about Germany and the fiscal break. So you are starting to see that rebalancing coming in. Look, I think it's overdone in the near term. I wonder how much we'll see, an impact on European growth this year. I think the fears about US growth are overblown. But for now, that's certainly what we're looking at in terms of capital flows. For years, the US has been the only game in town, and suddenly we're getting this rebalancing away.
Maybe this is a conversation for another podcast, but I've just come back from a week in Barcelona at Mobile World Congress, which is a big technology festival based in Europe, but with a very much a global view. Lots of US leaders there. I spoke with Brett Taylor, who's the chair for OpenAI. I spoke with various other leaders as well about Europe's place on the global market and this innovation gap. Eric Schmidt, from Google back in the day, spoke about Europe being the referee in a soccer match between China and the US. And two things about that. No one likes the referee, and the referee never wins. So there needs to be a change of position. Europe needs to become a player on the field and not an arbiter between the two. And there are some moves at the European Commission level to make some of that stuff happen and to try and make Europe great again. Who knows whether they'll get on the same line as what's happening in the US. But sticking with the dollar for a second, though, as part of my travels over the last few months, I've been to some parts of the world where I get to watch television that maybe I don't get to watch in the UK, and scrolled onto one or two channels where there were some markets talking about, so Russia, Brazil, India, China, panel discussions about the role that the dollar plays and about it being a kind of de facto currency in emerging markets, in other markets, but whether that is still tenable, whether with the volatility that we are witnessing, we are experiencing, whether that is still something that should continue, can continue. What's your take, both geopolitically but also economically, on the dollar's global role given what we're seeing right now?
I mean, certainly there's been talk for many, many years about the dollar losing reserve currency status, which is what we're talking about here. It is the world's currency. It's the most current, the held currency in global central bank reserves. It's the world's reserve currency, which, used to be a long, long time ago, until the 1920s, used to be sterling. And then the US sort of took over as it became the largest economy in the world. And so now it's the dollar. Its share of global reserves has been declining for decades, but it's still the biggest single currency in them. Around 60% of reserves are held in dollars. Is this under threat? I don't think so in the near term. Look, the policy of sort of ring fencing the US we talked about before and trade tariffs certainly, calls it into question. It's right to ask the question. The only problem is what replaces it? There's no obvious
Yeah.
replacement for the dollar globally as the reserve currency, as the trading currency, as the currency that you price commodities in, and a lot of trade invoices are priced in, as you mentioned, in emerging markets. What replaces it? The euro would be one that some people would argue, but we know the euro is still makes some people nervous being a single currency of a large number of countries that are not politically unified,
No.
or even fiscally unified. Maybe what's happening now will bring them closer together, but it's a long step from there to say it's one country, one economy. So that makes people nervous about it being the euro. The renminbi is another sort of potential given the size of the Chinese economy, but
Yeah.
it's not fully convertible. It's not a fully floating currency. That's another element. And it sort of goes back to a circular argument in some ways about the US current account deficit. A reserve currency has to run a current account deficit because being a reserve currency means you attract capital inflows. Well, if you attract capital inflows and you have a surplus on your capital account, you have to run a deficit on your current account. So at least some of the trade deficit that you have in the US is a result of the reserve currency status. Because what it means is that you have lower than natural interest rates in the US, and that encourages spending and consumption, and that leads to a current account deficit. So, in the grand scheme of macroeconomics, it's partly at least a function of reserve currency. Well, Europe runs a trade surplus, China still runs a trade surplus. They don't fit the bill for the reserve currency status. Now, there are others who would argue crypto could become the
Aha.
reserve currency. But you talk about volatility in the dollar,
Oh my
that's
word.
nothing compared with volatility in cryptocurrencies. So that's not
Yeah.
a winner either here.
Yeah, and you start looking at the market cap of, say, well, Bitcoin is the obvious example. After Trump's win, that was sky high, 80,000 or so. And you look at it where it is right now, middle of March, it has plummeted.
We actually got over
And
100,000 Bitcoin at one point.
sorry, I was thinking pounds, of course, but no,
Yes, yes.
in dollars. Yes, that's right. But no, it's plummeted to well below. I think we're parity with where we were 12 months ago, very, very
Yeah.
broadly. You mentioned emerging markets there, and just speaking to the traders, those who are looking for opportunities in emerging markets, what would you say are obviously the dollar is very important, as we've said there. What do you see as the risks and maybe the opportunities then, given the volatility, given the outlook right now? What are the opportunities that might be out there for the for the savvy traders?
Look, in the grand scheme of things, when it comes to EM, volatility and uncertainty are not good. EM currencies outperform in a world that is low volatility when we can broadly know what's going to happen. This environment is not a positive because in that environment, low volatility and high certainty, that's when you put the carry trade on, which is what emerging markets provide. They provide you carry, they provide you yield. The carry trade works in a low volatility environment. That's not where we are. Um, in addition, if we have a world of trade tariffs and tit for tat, that lowers global trade flows. Emerging markets in general are net exporters. They rely on global trade for a large part of their growth. That's not going to be coming either. So I think it's going to be a very, very challenging period for emerging markets. Are there still opportunities there? Of course. I mean, we've been big fans of the Turkish lira for a long time now. It gives you a tremendous return, 50% interest rates, and it's been remarkably stable over the last year or so. So that's one we still like. Um, Elsewhere, it's difficult. It's difficult elsewhere. Mexico has been one that a lot of people like, and actually, the Mexican peso has held up very well in the light of all this talk about trade tariffs, we're concerned that that won't last. That when the reality of what the tariffs will be, what that will mean, our concerns about the Mexican economy means we'll see fairly aggressive rate cuts. Asia, again, China is, will we get the big bazooka out of China in terms of fiscal stimulus? Maybe. It's been talked about for a while, but it hasn't arrived yet. That would be a positive there and for the region, but you're waiting for that to happen. And before that, you sequencing again, we're going to get the trade tariffs before that. So I think you've got to be very careful within emerging markets. I think there might be some RV trades, some relative value trades within it. Who are winners, who are losers in the trade war? India is one that a lot of people point to as a potential winner in the trade war because they're not big exporters of commodities and you do get a decent yield. So India is one that people look on reasonably favorably. But those big sort of open, maybe commodity, raw material based emerging markets, I'd be very wary of those in the near term. Or for the course of this year, quite honestly.
Yeah, there are still a lot of unknowns. And as I've said,
Yes,
middle of March that we're recording this, who knows what might even happen in the next 2 or 3 weeks with people around negotiating tables as regards Ukraine, still a handshake to take place with regards to minerals in Ukraine as well, and the 500 billion that might mean for the US. I might have that number in the wrong sort of place, but I think that's one of the numbers I've heard, and I'm not sure how long over how long that would be, but that would certainly be a big number to come into the US coffers, I guess.
Yes, I mean, you say we don't know what's going to happen over the next couple of weeks. Quite honestly, we don't know what will happen this afternoon. It depends what tweet we get or what a new announcement we get. We've lived with this now for 6 weeks or so. The hope is that I think once we get to April the 2nd, which for me is now the next key date, that's when we're going to find out about reciprocal trade tariffs, right, what level they're at, etc. And the hope is for me after that, we put on what we're going to put on, and then we have that certainty. We have that stability. Then the markets can really start to price that world. Because at the moment, it's hard to price. We're going into a new environment. We know that, but we can't price it properly because we don't know what the levels are. Are they going to stay? How long? Are they going to get delayed? That's the problem you have. You have that. We know there's a new thing to be priced, but we don't know what it is yet. At least when we know what it is, we can start to price it, and then we can find a new level, and then we can start to trade in a more orderly, less volatile way. And I think that certainty is what we're searching for.
April the 2nd, absolutely right. A key date. Who knows what will happen between now and then, but maybe some outlook from thereafter. Lee, we're going to have to call it a day for there now. Thanks again for such insight, such a broad knowledge that you have there, and you've been able to contextualize all of the stuff that I pick up on the news, that I see on the lines, and make it really accessible for us. So thank you so much. I hope we get a chance to speak again, maybe later on this year when everything may have completely changed. But for now, Lee, thank you very much.
Thank you for having me, and I would love to come back later in the year.
If you liked what you heard from Lee today, then a quick reminder that you can catch up on any of our previous episodes where we've had some terrific insights as well. You can find those over at the-cmx.com. That's the-cmx.com, as well as in all the usual places that you'll find your podcasts. Do leave us some feedback. The algos love feedback, and so do we. The CMX page on LinkedIn is a great place for that. And while you're there, tell us what else you'd like to cover in future episodes. Speaking of the future, some Finance Hive 2025 dates for your diary. Members meetings in London, Singapore over the last few weeks. They've been. Hi, if you were there, hope you had a good time. But the big one, of course, is still to come when everybody across FI, FX and equities will be coming together for CMX 2025, back once again at the Woolwich Works in London. That's on Wednesday, the 2nd of July. And if you want to find out more about that or about the Finance Hive, then head over to the-cmx.com. But for now, from me, David, and everybody else here, see you next time.